Welcome to our weekly market review. Now, when politicians won't listen, the market will tell them. And South Africa's long-end bond yields brushing 13% are a clear warning shot to the state, adding to the pressure pile facing National Treasury, who is tasked with balancing the country's dismal-looking fiscus as revenue dwindles. Now, some releases last week did show an unexpected improvement in performance, one of them being the budget deficit, which narrowed from the worst monthly budget deficit on record of 143 billion rand in July to a deficit of 47.3 billion rand in August. Now, the country's trade balance also remained in a welcome surplus in August, but that's about where the good news stopped. For one thing, government's net borrowing requirement for the year stands at 258 billion rand. Now, that's compared to 179 billion rand deficit for last year's corresponding period. These financial pressures will likely force the state to further raise debt at increasingly expensive rates, as we've noted now in the bond market. And it all raises the significance of the medium-term budget policy statement happening next month. There are indications of continued global disinflationary pressures amid the tight monetary conditions. In the EU, Central Bank President Christine Lagarde maintained that the bank's record high interest rate will drive inflation down to 2%, supporting market bets that the ECB's rate hike cycle is over. Money supply and credit extension data show funds continue to dry up, while headline and core inflation continue on a downward trajectory. Then over in the US, the data reflects a slowdown in consumer spending. New home sales have declined to a 5-month low, and the PCE core deflated, the Fed's preferred gauge of price pressures, fell to 3.9% year-on-year in August. Even the labour market, which has been holding up, has started to tip, adding to the signs of a possible impending recession in the US. Even so, the sentiment from the Fed remains hawkish, with rates likely remaining high for some time to come. Now, while we're on this topic, Head of Research and Director George Glenos and myself had a chat about the US economy and the possible debt refinancing risk. The podcast is now available on Spotify. It's called Reset the Frame. And speaking of which, the dollar saw a sharp retreat last week, adding support to the rand's recovery, and the strengthening also likely reflect a relief that the government finance debts were not worse and that the trade balance remains in surplus. Now, whether this recovery is sustained will depend on the greenback and the outcome of this week's US non-farm payroll data. So with not much else happening on the data front, the US labour data will be this week's main event and could hold market-moving potential. A softening labour market would be a significant catalyst to encourage the Fed to leave rates on hold. That then the week that was and the one to come for the markets.